VF Corporation stock is down over 61% in the last year. So, is it cheap? Should we buy it? Well, we will value and analyze this company to answer these questions, but first we have to understand why the price went down. And the simplest way to look at it is through earnings. Net income for 9 months in December 2021 was $1.3 billion. And just a year later, it was $333 million, almost $1 billion less. I can sort of understand why the price went down. Okay, so what is VF Corporation? It is an American global apparel and footwear company founded in 1899. And in August 2018, it was announced that VF would be split into 2 separate companies. The jeans brands such as Lee and Wrangler and also outlet stores would be spun off as Contour brands. VF Corporation kept 13 other brands, including JanSport, Eastpak, Timberland, The North Face, Vans, and Supreme. Let's see who owns this company. Individual insiders, that is an X at 0.4% of the company owned by individual insiders. And we would like to see this number over 2%. And are individual insiders buying? It is a check. There are a lot of different insiders that are buying the stock in the last few quarters. So that is really nice. And do super investors own this company? That is a check, but there is only one super investor that owns VF Corporation, and that is Lee Ainsley. And it makes up only 0.14% of his portfolio, so nothing major. And are super investors buying right now? That is an X, and although Lee Ainsley bought over 205,000 shares in Q4 2022, but other super investors sold all their shares, so 444,252 shares to be exact. Return on invested capital. That is a check at 14.1%, and we want to see this number higher than 10%, so that is an encouraging result. And what about free cash flow growth? That is an X with 6% decline. So that is something we never like to see. Unfortunately, that is a red flag. And what do we know about net profit margin? It is an X at 3.5%, and the sector median is 4.6%. So another poor result. And now let's take a look at share buyback. It is a check. They bought back 2.8% of their shares back since the spin-off in 2018. And how is the debt looking? It is an X. It would take them over 5 years to pay back the long-term debt with an average free cash flow since the spin-off. If we would use the current free cash flow in this calculation, it would be even worse, over 8 years. So now let's take a look at the dividends. The dividend yield is 5%, so we get $1.20 annually per every share. That is a very nice dividend yield. And what about the payout ratio? That is an X at 84.1% payout ratio. So that is a very big problem. Almost 85% of their earnings goes to dividends, and only 15% is left to grow the company or pay back debt. But how did they get to this point? Well, let's take a look at the growth of the dividend. It is a check at 1.8% 5-year growth rate, and this dividend is growing for the last 49 years, if we look at the whole history of the company, not just since the spin-off. So the company got split in two, the earnings went down substantially, but the dividend kept on growing. That is why we have this massive payout ratio. PE is 22.5, so it is quite high, especially if we consider the fact that the price of the stock went down by around 60% in the last year. But at the same time, the earnings also went substantially down. So that is why we have this high PE. Okay, so to value this company, we will have to estimate its growth for the next 10 years, and we will make 3 scenarios: low, medium, and a high one. So in the low scenario, we will estimate a decline of 3% for the first 5 years and no growth after that. In the medium, no growth for the first 5 years and then 2% growth. And in the high scenario, 2% and then 4%. These estimates may seem low, but if we look at the growth of this company in the last 10 years, we get -6% free cash flow growth, 0.9% revenue growth, and 3.8% earnings per share growth. So let's try to be conservative and just stick to such results. So with these estimates, the intrinsic value in the low scenario is $11, in the medium $16, and in the high scenario $20. But we have to always add a margin of safety to these prices. I use a 30% one, and with such a margin we get in the low scenario $8, in the medium $11, and in the high one $14. And the current price is around $21. So unfortunately, it is all in the red at the present time, even though it is really close to the high scenario without the margin of safety. But that is not the full story. The price may seem high, but let's remember that in a year's time, this company will be a dividend king with 50 years of dividend growth. And the payout ratio of 5% can be appealing, though it seems a bit too much for this company to handle at the current time. The only other thing that is really encouraging is that a lot of insiders are buying this stock currently. So maybe they have a strong conviction that this company will turn around and will start growing much faster than we anticipated. And if you want to find the best bargains and the best companies to buy currently, then head over to our Patreon page, where for just $5 a month you gain access to our stock ranking, which makes finding great investment opportunities really easy. Thanks for watching and bye-bye.